Hello, everyone. This is Edwin Epperson, your host of The Sophisticated Investor. The Sophisticated Investor is an incredible community which is focused on education, training, and collaboration to help each of our members, and that includes you, to build, protect, and preserve your family's generational wealth. Now, I believe that we truly have a unique and one-of-a-kind educational community. For one, I believe that there are 4 primary markets, not just one. I believe that those 4 primary markets include your personal finance and mindset market. I believe the second market is your hard, tangible asset market. I believe that the third market is your stock and paper market. And I believe the fourth market is your business investing market. Now, those 4 markets are imperative to be able to understand and then call yourself a sophisticated investor. Today, we have an incredible guest who is going to educate us on their preferred market of investing as well as the assets that they like to invest in. Please join me as we welcome today's guest. And today we have with us Ray Burkhalter. Ray, thank you very much for coming on The Sophisticated Investor.
I am excited to be here, man. It's an honor that you allowed me to come join in and have this conversation with you.
Absolutely. Well, I'm excited about having you on the show, and I know that the listening audience is going to be excited because, one, you have a lot of wisdom, a lot of experience within personal finance and the real estate space. I mean, I have known you for many years, and so we'll dive into a little bit about your background, where you've been, what you're up to now, and then just really some of the key points as far as personal finance and what people can take away from this conversation to apply to their own personal finance and give them some key points and steps forward in improving their financial positioning. So if you will, walk us through a little bit about what, your background, where you come from, and what you've been involved with.
Well, I live in Tuscaloosa, Alabama. So if there's anyone seeing this on the screen, I'm supporting the home team here with my shirt. So it's Alabama Roll Tide. But yeah, I got a mechanical engineering degree from the University of Alabama and had a career in that field. And after about 10 or 11 years in that line of work, I realized that there wasn't any passive income that I was going to produce from that job. And I ended up in the automotive industry, which there was a lot of things I loved about that, but it did require sometimes extensive travel and odd hours. And sometimes there's a lot of pressure in that work. And as I looked upstream where I would be headed up into the management, they didn't seem like, genuinely happy people just because of those pressures. So when I looked ahead at that, it was like, is that really the ladder I want to climb?
Yeah.
There's that saying that sometimes you can climb the ladder to the top just to realize it's propped against the wrong wall.
That's true.
And I didn't want that to happen. So my wife had been interested in real estate prior to me having this revelation about no passive income from my engineering job. So I started looking into real estate investing, and we ended up starting an LLC back in 2005 and bought our first property, which is a triplex. We lived in Tennessee at the time, and just started doing a lot of real estate investing work from then. And by the beginning of 2008, I was able to leave the engineering career and do the real estate full time.
And that's exactly what you've been doing since 2008. And then even more important, I met you in 2000, and I think it was 2014.
I think so. Yeah, in Dallas.
Yeah. And so for those who are listening, Ray he's invested in real estate, but he's also been a coach and a trainer and a teacher and an educator. So Ray's got that unique ability to pass on his knowledge and information and skill sets to other people. So, and Ray has been instrumental in helping me get and accomplish what I have and where I'm at right now. So This is, again, an honor to have you on, and more importantly, to talk really about something that's key and critical for you, and that you see a lot in your students, people that you've talked with, people that you've coached and mentored. And so, without further ado, let's just go ahead and dive right into, on the personal finance side, some of the key points that you have seen investors, either mistakes they've made or issues that they've overlooked, and they don't think they're that important, but in the long run, it tends to bite them in the rear.
Yeah. With that said, I know so many people just want to jump straight to investments. Let's talk about investments. Let me do that. Let me get into that. But in many cases, people will take that step, and I applaud that. But if they do that before they have their personal finances on a really solid footing, and not only that, but that it's taking them where they want to go. If they go into investing before having the personal financial situation really nailed down, it could lead to an instability later on and some troubles. Whereas, if you really want to build a nice portfolio, for most people, there's going to be some bank leverage involved, and you need good cash reserves and you need good credit for that. But sometimes, in the rush to move forward, people don't take care of their credit and they don't take care of cash reserves. So, with all that said, the first of a handful of points that I wanted to make in our conversation here is step one, to be sure that you have a written financial plan in place. A lot of people might have the framework of a financial plan in their mind, but having it on paper just really takes it to the next step. And for anyone doing this that has a family, I'd recommend that they include their family in that financial planning. People that depend on you, that are either literal dependents, children or spouse or something like that. Build that plan with them together, because it impacts them, and it also gives you the chance to pass along financial wisdom to them. And that's going to be, I'll go deeper into that in another one of the points that I want to make later. But involving those that you care about that's going to be impacted by this financial plan could be a huge step.
Now, when you say a financial plan, some people may have the thought of, whether it's a budget, the B word in, personal finance, whether it's a budget or whether it's a really intricated, like you've got CPAs and attorneys involved, and for some people that just may be overwhelming. Some other of our listeners already have some of that in place. In your opinion, what does sitting down and creating a financial plan look like? What does that entail? Without getting super detailed, but just a little bit more detailed.
Yes. It starts with some goals. A goal gives us direction. It helps us to make decisions on just some of the day-to-day, but some of the bigger decisions as well. So some goals like cash flow for your short term. What do you want to be earning in the short term? And I know you and I had a conversation on this not too far in the past, because of some messages we were swapping back and forth, and I told you I had scaled back on some of my cash flow goals, and you were like, why? What's that about?
Yeah.
Having a cash flow goal, this is something I learned in the not too recent past myself. You can reach a cash flow goal that becomes kind of, what's the right word? It's not really self-defeating, but it hits a point of limitation, so that it's that the more effort you put in for the returns that you're getting out, it's
like a diminishing return.
Much of a diminishing return. Yeah, that's the phrase I was looking for. Thank you. So what is a short-term cash flow goal? That's one thing that you'd want to have in a written financial plan. A passive income goal. And for anyone that has done the Robert Kiyosaki cash flow game, you know that in that game, you're trying to have your passive cash flow equal or exceed your monthly expenses. So having a passive income goal. And then when you think about the future, a net worth, that's going to really impact your borrowing capacity and being able to do some other interesting things when you have that net worth. So those are three things from a goal standpoint. Then, as you mentioned, what is your month to month spending? If people don't like the budget word, it's equally as effective to say your monthly spending plan.
There you go.
So just spending it on paper before you actually spend it in real life. I found that to be very impactful. And people who don't even really do investments, just friends and family, people I've networked with, sometimes have asked me to help them to work on their spending plan, because so many people, unfortunately, in our very, very well off society here, a lot of people are living paycheck to paycheck. It's just because they haven't, either they don't understand the concept or how to do it, or it just doesn't seem important. But they just live, spending on plastic, and it's so hard to have a feel of how much outgo there is when it's always swiped, unless you take some extra measures. So, yep, how much do you spend each month as a part of your written plan? But also other things. I am so sorry, but that you said earlier, telemarketers.
Oh, they're good. They have
having
impeccable time.
Health insurance. They do. But another piece of a written financial plan is your health insurance, life insurance. Those are two things that people may not think about when they think about a financial plan, but it is, especially with the healthcare cost just going up year after year, like we've seen, I don't know, at least the past decade, maybe longer. But that's when I've really felt the pinch, especially when they changed the insurance regulations a couple of years ago. Healthcare got a lot more expensive. But the life insurance piece as well, man, that's huge. I mentioned a moment ago, include your family or close, people in your financial planning, having a life insurance policy that's going to cover them. And one of our common friends and mentors, George Anton, taught me about a life insurance strategy that you can do investing out of. And so that's a pretty powerful concept. You can get the benefits of life insurance and also do some investing with these high cash value policies.
Yep.
But sometimes that's just things that people don't think about in their financial plan, of having the proper insurances. And some people would also maybe want to have a disability insurance. But my thinking is, if you're really working on this passive income, you're going to be self-insured for that. So that's why I don't include it.
Self-insured, that's a really powerful term. Maybe at a later date we could delve into that, about the power of being self-insured. And some people may have never heard of that before, but to think of being in a position financially to where you are self-insured, that's really powerful. I mean, that's, talk about freedom to know that you're self-insured. That's wow. That's pretty impressive. That's something to definitely have a goal for.
Yeah. Well, I think there's a place for insurance, but then in some places, like with the disability, hey, if I've got enough passive income coming in to pay all of my bills, if I became disabled, it wouldn't really matter. As far as from an income standpoint, it would matter to me personally, but from an income standpoint, I'd still have the passive income coming in. So I wouldn't, what's the point of paying for that insurance when I've taken care of that, that what if?
Yeah.
By doing the passive. But just a couple of other quick things to mention on that written plan concept. A will. Man, you wouldn't believe how many people, they just think that it's almost like a taboo topic. Let's don't talk about that. Like if you write your will, you're going to die the next day. not likely to happen. It's really responsible for the people that you
Yes.
care about, because if you were to pass away without a will, man, you're leaving them to just deal with all the mess, and it
Man,
can be.
you mentioned that, Ray, and there's a gentleman that I know. He goes to our church, and him and his wife are very involved. And we've seen them. He's from Kentucky, so him and I have that bond. We're both Kentucky country boys, and so they work in the insurance industry, and he, with the last month, found out he had leukemia, and so he's been taking chemotherapy. And him and his wife are very, very publicly open about, hey, we're discussing our will. Like, here's our will. Like, we're talking, we're planning, even though that we're having faith and we're believing that, he's going to be healed. It's that power of sitting down, that comfort for the ones who potentially will be left behind. They have everything in place. Like, they know exactly what your will and testament is. Like, this is what I want to happen. That gives a lot of comfort, and it can assuage a lot of angst and anxiety of moving forward. And like you said, some people have a taboo about it, but it really is something very important, and it needs. And there have been so many stories, and I know you've heard these before, where somebody doesn't do their will, and then there's that bickering, there's that fighting, there's this unknown. Oh, well, I think they would have wanted this. Well, I think they would have wanted that, and it can sometimes tear families apart. So, absolutely, I agree with you.
Yes, it definitely can. And so it's the will is not for us; it is for our loved ones. And if they fall into that category of loved ones, and we want to take care of them, so having that thought process. We just updated ours recently, and it's our life situation changed in the year since we had done our first one, and just having to think through that. What do we want to happen? How would this happen? How it was an interesting conversation, and it was a good one between me and my wife, and then we talked to the heirs, some of them, about it, to let them know here's the direction we're going in. So it's a good thing, and hand in hand with that, and any attorney that's going to help you with your will could help with this too. But kind of the power of attorney for your health care.
Well,
I know it
really,
maybe sounds odd thinking about that with financial planning, but it is a piece of kind of the financial plan. If something were to happen health wise, and you couldn't make decisions anymore, how would you want that to go?
There you go.
So that's the plan piece of it. Does that kind of all make sense?
Yeah, that definitely makes sense. And it's some points that I think when people think of financial plans, so going back, and when people think of financial plan, I think for the most part, what they really focus on is that monthly expenditure. They don't see all the other planning aspect of their financial future, where they're at, where they want to be. And that's really key. You've given some great topics on if somebody wants to sit down and really get serious about their financial plan, to do it. Now, here's another thing. People hear all this. They may be listening, and they're making notes, and they've got, I've got to create a cash flow goal, a passive income goal, a net worth goal, monthly expenditure plan, healthcare and life insurance, have a will, they're like, my goodness, like this would take forever. If somebody were to really sit down and say, you know what, I'm going to sit down with my wife, my spouse, my better half, my family, and let's get down to the nitty gritty and get this knocked out. What do you think that time frame would look like, realistically?
It would probably be pretty workable if they just worked on one thing a month.
Yeah.
If the and I think most people probably have the health insurance piece in place already, and many may have the life insurance. But if not, it doesn't take that long to do what you need to do with life insurance. And man, the sooner you can do that, the better. I know when I got mine in place, like the day that I was supposed to sign it, I got news back from my dermatologist that I had skin cancer on my cheek. Like the day that I was literally supposed to sign my life insurance policy. I was like, oh, well, what's that going to do? So I emailed my agent, and he said, let me check. He said, depending on the type and everything, you may not be insurable now for 5 years. And it's like the day that I was going to sign it. So fortunately, the type that it was, he sent me a message back the next day, and he said, this isn't even going to change your preferred rating. He said, this kind, they didn't even bat an eye at it. So that was pretty amazing. but literally things can happen overnight. So that one would be a pretty high priority. And then as far as setting your numbers, I would almost say start with the passive income goal first and kind of discuss that. Where do you need to be comfortable financially? And then cash flow goal will be second, and net worth could be done later as those other two are really getting traction.
And really, to even be able to accurately do your passive income goal, you have to know what your monthly expenditures are. So really taking the discipline and sitting down and saying, hey, listen, this is my monthly expenditures. This is where money's going out. This is where money's coming in, and assessing what your current assets and liabilities are and where money's flowing, I think would be a foundational issue to be able to begin to dive into your passive, then your cash flow, then your net worth.
Yes.
All right. Excellent. Well, I'm interested to hear this next topic that you have. So you've got 4. We just covered the financial planning, cash reserves. Now, for the listening audience who is just tuning in, I've got with us Ray Burkhalter. He's a coach. He's a mentor. He's a real estate investor. He is a personal close friend of mine, and he's sharing with us. We just got done talking about the planning, financial planning, and now we're getting ready to go into another topic that I think can be an argumentative point, especially for the investing. For investors, they're always about velocity of capital. How can I put, every one of my dollar bills as an employee, if I'm not putting that employee to work, they're lazy, they're costing me money. So let's dive into this next one of cash reserves.
Well, cash is king, and there is that school of thought out there that I should keep as much of my money invested as possible. But anyone that lived through the last financial downturn, and if you didn't live through it as far as being an active investor at the time, you can talk to people who did or watch videos on YouTube about people who have testimonials. But the big thing that tripped so many people up at that time was not necessarily that they made poor investment judgments on what they invested in, but they didn't have enough cash reserves to see them through the slow time. It's just unrealistic to think that there's not going to, at some point, for some reason, be some hard times.
Yeah.
And getting caught without cash can just be a killer. So let me, I guess, preface all this and even the last piece about the financial plan by saying I'm not a financial planner. I'm not in that realm. I'm just sharing all these things from my own experiences and trainings and what worked and what didn't.
Yeah.
So I'm not here to
So for everybody that's listening, there's the disclosure. Ray is not a financial planner.
Not a financial planner. But 6 to 12 months of your monthly expenses is a really good place to be. So as we were just talking about before on the previous topic, knowing those monthly expenses, not guessing, but really, literally, what are my kind of monthly normal expenses? And you might say, well, that sounds like, a lot of cash, but
that's a lot. For some people, that's a lot of money sitting there.
Well, and let me say this too. There some people would look at like their regular monthly expenses. Now, when I went through this exercise the first time, I didn't. When I looked at planning out my months of monthly expenses, I trimmed the fat. So I don't have to have cable television if I'm in emergency fund mode. I don't have to have gym membership. I don't have to have this and this.
Okay.
So I just really trimmed out to cut some of the things that I wouldn't have to have in that situation.
So when you were planning, so let's assume because the likelihood of people listening that have consumer debt will be probably pretty high. So as you're looking at doing your cash reserves, for you and your wife, when you all were planning and you were saying, hey, worst case scenario, we're laid off, we have no income, we need to have enough to survive for 3 to 6 months until I or my wife can get a job and start producing some, active income. Did you include your credit card payment to Macy's and Capital One and Bank of America and Chase, or were the credit card payments, they were not included for you and your family as far as the financial or that cash reserves?
Well, fortunately or unfortunately for this scenario, we don't carry any credit card debt, and I never have in like the past 25 years. I just pay it off every month. So from a personal standpoint, that wasn't even on the table. If I were in that situation, I would seek to preserve my credit, if possible. So I would budget in for some minimum payments on those.
There you go.
And factoring it along with an aggressive program for getting out from under those.
There we go. There we go. Absolutely. And so that's, and is there anything else? Because I really want to dive into, so you've got two others here. You've got pay yourself first, which is, I think, a great strategy. And a lot of these sound very familiar to Dave Ramsey's financial piece. Though I, like yourself, understand the power of leverage. And by not utilizing leverage, you miss out on the ability to really build, protect, and preserve your family's generational wealth. However, as you look at your credit and preserving your credit, your cash reserves, if somebody has debt and you say, okay, listen, if you're planning out your cash reserves for 3 to 6 months, hopefully even longer, as you build that reserves up and you need to take into place, having some money set aside to pay credit cards to maintain that credit. Why, some people may be of the school of thought of, you know what, I went out, got a Macy's card, spent $5,000, racked it up. If worse comes to worse, I'm just going to let it go. It doesn't matter. Why is it for somebody whose really intention is to position themselves to build, protect, and preserve their family's generational wealth? Why is it important for them to really take in consideration their credit?
Well, you just mentioned leverage a moment ago. If you want to go the extremely slow route and maybe not even keep up with inflation, you're just going to go off of your earning power. There's more than one kind of leverage. There's debt. Everyone knows about debt. You can go to the bank and get a loan to do an investment. But there's also equity partners. And in either case, they're going to want to know that you're honorable, with when you give your word and you say you're going to pay for something, that you do everything you can to follow through and pay for that. Having those cash reserves makes you look good to a bank. Mm-hmm. If you want to buy some investments and you want to leverage up with a bank, it also makes you look good to equity partners. Because if you're going to go in and buy a single building or a multifamily building or any other kind of asset where you're bringing in equity partners, they want to know that you're not broke and working on a shoestring budget yourself. They want to know that you're on solid financial footing, even if your part of the deal is just to put the deal together.
Yeah.
Even if you're not bringing cash to the table in your equity piece, they want to know that if you've got a low credit score, there needs to be a good story behind it, and not just the fact that you decided not to pay your Macy's bill because you didn't feel good that day. So someone was asking me, I do private lending as well, and someone was asking me recently, did I look at a person's credit if I'm going to lend to them on an asset-based loan? And if so, why? And I said, I in some ways, it tells me about their character.
Interesting.
So if they went through a nasty divorce and their credit score is low, if they had medical problems and it's low, if there's some other things like that and it's low because life happened, I get it.
Yeah.
But if they just dumped on their bills and just, I don't know, as a lender, I don't want to see that someone just walks away from their responsibilities.
Interestingly enough, we had a gentleman that we did a loan to here 2 weeks ago, and his credit score was below 600. and we pulled his credit. We were taking a look at it, and literally across all three credit bureaus in 2016 in October, like from then on for almost 9 months, no payments on any of these credit cards. And so we went back to him and said, "Hey, like, you've got really low credit. What's the story here?" And sure enough, he had filed a fraud. He had filed a fraudulent report on all three. And the thing is, that filed report was actually it was reported at the bottom of the credit report. All three credit bureaus had that report on file. And I think that that's always important. If somebody says, "Oh, well, there was fraud," well, did you go through the steps necessary to report that and try to protect yourself? And so I think that's really, really important. And I think that, and for us, that was enough proof. We talked to him. He submitted a formal letter, as well as being able to speak with we didn't get to speak with the credit bureaus, but seeing their reports that he had actually followed through and filed that claim. It was important for us to be able to do the loan. And so, yeah, but that story, that backstory of why someone's credit is important. And I 100% agree with you, Ray. It's a telltale sign of their ability and willingness to do what they say they're going to do.
Yep, I agree. So the last little point that I wanted to make on cash reserves is this: that to me, there's a difference between your cash reserves that you're not going to spend unless an emergency, and things that you're saving for some planned expenses. So guess what? The tires are going to wear out on your car one day. Your washer and dryer, they're going to go out one day. Things like that are going to happen. So you can save up for some things. Hey, you're probably going to take a vacation.
Yeah.
Instead of taking that out of emergency fund, I like to have a separate savings account where I'm saving up for things like that.
There you go.
Found that to be very helpful.
Excellent. So we've covered written financial plan, cash reserves, and then paying yourself and measure and adjust. We are coming up on almost 30 minutes now, and I don't want to keep you too long. So paying yourself first and measure and adjust. I think pay yourself first is a little self-explanatory. We could dive into that more, but I'd really like to hit the measure and adjust. What does that look like for you? And as you're, in your past experience of speaking with investors and clients, why is that so important to be able to measure and adjust? And what have you used in your personal life to be able to measure and adjust?
Well, if we don't measure, so the adjust only comes if you're measuring. If you don't measure, then you're not really sure if you're on track or not. You're just kind of living life, and you got money in the bank. That's a good thing. If you're low and you struggle to pay your bills, it's a bad thing. But if we measure and we're off track, that's when the adjust comes in. So what are we measuring? Well, that kind of goes back to step one of having the written financial plan. And we measure, and this is where I would bring in a business acronym, a KPI, a key performance indicator. So we want to measure what's the status of our cash reserves. If we said, $4,000 a month is our bare minimum for our expenses, and 6 months of those is $24,000 in the bank, then how are we doing on building that? I would measure pay yourself first, because as easy as it is to say that concept, it's sometimes hard to do that if you haven't been in the position of putting aside and having this concept of money that's going into your capital account that you're never going to spend. That can be a big deal. But measuring your budget that you've set or your spending plan compared to your actual expenses. Am I going over consistently in some areas? Looking at those things each month with the important people in your life that you started the plan with. So I promised earlier that I'd talk a little bit more about that. If you're meeting monthly with your spouse or family or whoever helped you come up with your financial plan, it is an excellent way, number one, to monitor how are you doing on these important areas. but also just passing along that financial knowledge. There's so many families that go from generation to generation, and it could be because the parents struggled with finances, or it could be that they had a lot and they just didn't want to talk to their kids about it. But what a disservice if parents don't teach their kids about this important topic of finances.
If you don't mind me asking, why do you think that is so hard for families to sit down and do that? Is it potentially they don't think they are knowledgeable enough to be able to share the information, or maybe they don't feel confident in sharing the information? What is it about talking about finances with family, which is, I've heard it being compared to talking about sex. Like you don't talk about finance. It's sort of like sex. You just don't talk about it. Why is that the stigma on passing on the knowledge and information of finance?
Yeah, that's the $1 million question. Why? Finances, for some reason, are, for most people, a very personal thing.
Yeah.
And that's okay. But just like you really don't want your kids to learn about sex from other kids in the 5th grade, you'd rather for them learn from you,
yeah,
a healthy and wholesome way to talk about it and tell them the real facts, and not let them hear it from someone that heard it from someone that, saw it on a X-rated video.
Yeah.
The financial discussions, I think outside of a discussion like this, where you're just saying, hey, here are our family goals and you helped come up with them, here's where we stand on those this month. Outside of that, how do you sit down and have that conversation with son or daughter? Do you just bring them in one day and say, look, I wanted to show you kind of where we are in our finances, without almost having an agenda and like a monthly meeting time? It could be a little awkward. But
Yeah.
when you just set it up that way and you say, look, outside of our faith and our health and a couple of other things, your finances in life are one of the most important. It's going to have a huge impact on your happiness while you're in this world, and your ability to give and support others.
Yeah.
So let's sit down and have this meeting every month. But yeah, a lot of families, it just does not get passed on.
And it's interesting because my father was a business owner. He was a business owner, and I never remember sitting down and having a conversation. Granted, he was very busy with work, and I was not interested in finance at all. But it was just, and it just goes to show, it's a reflection of a vast majority of families in America where this finance is it's just not talked about at all. And then you have these gurus that speak whatever your itching ear wants to hear, and they're like, yes, Bitcoin's at $5,000, you should buy now. And so people are, it's just like those things. And I think we get, a lot of people get caught up in that trap of, chasing the shiny object instead of really building foundation in which they can build their financial future on. 100% agree with you, Ray. Well,
and it doesn't have to be complicated. It just and having the buy-in. So, you said you weren't interested in having those conversations with your dad back then, but what if he would have approached you to be part of coming up with this financial plan?
Yeah.
All of a sudden you have a vested interest in it, and now you take 30 minutes a month to sit down and discuss this. It's because you had a part of building it.
Yeah, that's true. That is true. Well, we are coming up on the hour. I want to just sort of open the floor for anything else that you wanted to visit or touch on before we wrap up, and then we'll give out how people can reach out, get in touch with you if they want to, and how they can reach you, and then we'll wrap up the show.
Yeah, I would just want to circle back for just a moment on the pay yourself first, and really anchor on that, because if if people don't get that one, if you don't start building a capital account for yourself that you're going to invest from, it's hard to ever really get traction and grow. You end up spending that money on something here or there, and it's a concept I learned from the Richest Man in Babylon book.
Mm-hmm.
But it just, to hear it inside of the story in that book and seeing it happen in a fictitious person's life, even though it's fictitious, man, just seeing it in a person's life of how it played out if you do it and how it plays out if you don't do it, is huge. So I know people can give that one lip service. And even for me, the first time I read that book, I didn't do it. And to sit down after years of not having paid myself first and work that into my budget, it was a challenge. I had to move some things around. But having done that, I wouldn't take anything for it and the effects that I've seen on my finances. So just anchor back to that one.
So, and you mentioned the pay yourself, and you said a capital account. So, a lot of people, and I did go over that briefly because I wanted to get to the measure and adjust. But when somebody hears "pay yourself first," or maybe the first thought is that, oh well, I'm taking $20, sticking it in my pocket so I can go to the movies or go spend it on whatever. That's not what you're talking about.
Correct. Yeah, it's when you pay yourself first, you're setting aside preferably at least 1/10 of your net income into an account that you're never going to spend that account. And that was a concept that it took me a long time to wrap my mind around that. But it's money you put aside every month and you're never going to spend it. And the strategy is you keep growing that and you keep investing that and you get the compound interest effect. And then the more years that you do that, you end up with a capital account that is so large, it's generating that passive income that you're looking for.
Wow.
So it's key. It's a key component of your passive income. So that's one of those things that the sooner you start it, the better. That's why I didn't want to skip over it, because people can think, they can get the wrong ideas about pay yourself first. So I can't think of a better tool that teaches that than the Richest Man in Babylon book. It's an easy read. I'm going through it right now with my 22-year-old nephew. We meet every Friday and we discuss a chapter of it. And I'm so excited that at 22, number one, that he's even asking me about it. And number two, that he's getting it and starting to apply the principles there.
Yeah.
Wow.
But,
and just to say, when I say pay yourself first, I'm a follower of Christ. So I actually tithe first, and that's my first 10%. But the next 10% of paying anyone else is to pay me beforehand. So I've learned to live comfortably on 80%, less the taxes that I have to pay.
So interesting. So you're saying that you put that 10, so you give 10% as a tithe to God, and then you keep 10%, you put it in you pay yourself first in the capital account, and then you live off the the rest of the 80%. So you're not, of that 10% that you're paying yourself, does that out of that money, are you also financing your cash reserves account, or is the cash reserves account an expense that is paid out of that 80%?
Again, I already had my cash reserve account built before I really started doing this. So if I were going to put those in one order, I would say build the cash account first.
Yeah.
At least 3 months, preferably 6 months worth, because you've heard of Murphy's Law, right?
Uh-huh.
And not to, sound just like Dave Ramsey here, but I mean, literally, if you don't have cash on hand, that's when more bad things tend to happen.
Yeah.
And another just quick warning piece there, when you do have cash reserves, if your extended family knows that you do, they'll want them to be their cash reserves as well. So family members, if they don't have their own cash reserves, one story in the Richest Man in Babylon book was the essence of it was, don't make another person's problems yours. So you can teach them about a cash reserve, but I hesitate to give someone else my cash reserves, because that's for my family.
Exactly.
That's for my family's emergencies.
Yeah, exactly. Well, Ray, it's been a pleasure and an honor, sir, to have you on the show today. And so we're going to be posting the show notes, how people can reach out to you. We've got your Facebook and your LinkedIn. Is there any other method or avenue that people can reach out to you? Do you have a website or anything like that that people can get in touch with you?
I don't have a website because I'm not currently doing any kind of teaching or training or anything on this kind of topic. But if they want to reach out to me by email, I'm open to answering questions like this. I feel it's part of my, serving and giving back is to help people understand, because it's hard to be happy in life if you're struggling financially. And once you really get some of these concepts, it's not as hard as our society makes it out to be. But it's just the fact that much of this stuff is not taught and not modeled by some kind of financial mentor in our life. But once you get it, it's not that hard. It's just the getting it started piece and actually having a plan is the hard part. But yeah, just rayburkhalter@gmail.com is an easy way to reach out by email.
There we go. And then, of course, a book that you mentioned several times throughout the podcast today, The Richest Man in Babylon. And so we'll definitely have a link to that book in the show notes as well. Ray, thank you so much for being on the show. I look forward to having you back on at a future date, and definitely look forward to meeting you and your lovely bride at a later time as well, sir.
Absolutely. It sounds great. Thanks for the invite. I've enjoyed it.
Absolutely, sir. Thank you. And that wraps up our show for The Sophisticated Investor. Thank you so much for joining me and joining our guest today as we dove into the specific assets and the market that they invest in. Please join us again when we dive into more investing techniques and strategies in different assets within different markets so that we can help you, the listener, and our community member build, protect, and preserve your family's generational wealth. This is Edwin Epperson, your host of The Sophisticated Investor. God bless and have a great rest of your week. They're either really inexperienced and they've never done transactional funding, or that's the only thing I can think of, because they sound young. When I talked to them on the phone, the attorney in the law firm, they're familiar with it, but this young lady who's handling the documents and the actual closing, I don't think that she's very familiar with transactional funding. So she, and albeit, she was trying to do the right thing and get everybody on the same page, but that just opened up a whole nother can of worms that it was not necessary to open up.
I think I know what my piece in there would be. If I were doing it again, I would have my title company doing that closing to make sure that.
Yeah. So, and I agree with you. And I want to ask you a question then. How do you do that? Because as a transactional lender, honestly, I mean, it's where title is pooled, especially in this scenario, it's not really up to us. It's the seller. In this case, it's an estate. So the estate trustee is an attorney, and they picked the closing company. The buyer who got it under contract said, okay, obviously you're the seller, you get to pick. So we get pulled into it, and we're at the behest of whoever they picked. I mean, how would you work? How do you just go in and say, hey, listen, if we're going to do this transaction, then we have to do it at our title company. We just force that?
Well, you have a good story now to tell your buyer, hey, if you want this to go through without a hitch, we found that when title companies aren't familiar with this, they can blow your deal up. But we know that XYZ title company is very familiar with this, and they can do it without a hitch.
Yeah.
So just kind of put it back in their court to let them know it could blow up, and it's not your fault. It's I mean, we've not that exact scenario, but we've had things happen before, and we just kind of started coming back. And we work with repeat borrowers, so we have the opportunity there to say, hey, if you want to go with this other title company, it's going to cost another half point or something like that, because we've, dealt with them before and their headache.
Yeah. Interesting. I have a originator that's working with me, and I asked him, I said, hey, make sure the borrower understands that the title company they're using has to understand transactional funding, the A to B, the B to C, what parties need to be informed and kept in the loop concerning what process or what part of the process, so that there's no confusion. And we were told by the borrower that, yes, this title company understands transaction. I just think it's the title agent themselves that maybe has never dealt with it. So, yeah, it is what it is. It's a learning experience.
Hopefully it goes through.
Yeah, I think it will. There's just so many things. It's like, man, if it's not one thing, it's another.
Yeah, it was it's good for me to pull those 4 points together.
Yeah, I'm sorry about skipping over the just briefly, and I know as soon as you mentioned, like, yeah, I did the same thing. That's what most people do anyway. It's like, yeah, pay yourself first, and let's move on to the other stuff. But
that is a hard one to start.
Yeah,
it is. But man, I could kick myself for not, having done it before I finally did. But I read that book the first time through, and I was like, well, this makes a lot of sense. But I would say that discussing that, not just reading it for yourself, is one thing, but like I'm having those weekly discussions with my nephew, that takes it to a new level.
Interesting. Do they have like a study book to go along with it, or you just simply read the chapter and then you come back together and discuss that chapter?
I bought a Kindle version of a study book, but I'm not so impressed with the questions at the end. So what we end up typically doing is I will highlight in my Kindle reader the things that stand out to me, and he'll highlight the things that stand out to him, and we just make sure that we cover those. And then I check him for application points. So some of the things in there are the 5 laws of gold, and I've pushed him to say, how will you implement this one? How you implement this one? How you implement? And then we'll talk about some real life stories of, how do you apply some of those? And I'll point them back.
Wow.
So, man, just really discussing that with someone is so much more powerful than just reading the book by yourself.
Yeah.
And the story that it's wrapped up in, because I watched a thing on YouTube that was a summary of it. And when you just see someone drawing on a whiteboard, save 10%, pay yourself first, do this, it has none of the impact of reading the story and seeing what happened when people did apply it and what happened when people ignored it.
Yeah.
So much different.
Interesting. I've heard that book multiple times for many, many years, and I have like a running list of books, and Richest Man in Babylon is still it's one that I want to get. I haven't had the discipline to sit down and get the book and read it. I think I'm going to have to.
It's a pretty easy read. It's not that thick, and it's almost the whole thing is just a story. Yes, it's set in ancient Babylon. Yes, there's almost some King James type language in there. But yeah, even with this 22-year-old, he's reading it, he's getting it. And then
that is so cool. That is so powerful. So powerful.
No, some borrowers that I've onboarded.
Which onboard platform are you using? Which origination platform?
We didn't end up going with one yet.
Oh, no.
It was just so costly and complex. I forgot the one that I was telling you that we were looking closely at.
Liquid Logics?
Yeah. Gosh, man, they sent me their thing in, and it was like $25,000 to onboard, and then a ton of training. I'm like, nah.
Have you looked at the loan post, lending wise? Ray, I want you to look at lending wise. Chris Fueling is the CEO. I'll shoot you an email after this, and I'll connect you with Chris and his lead developer, Dave Eschmeyer. They have he's done some growth. So I was with Chris back when he first started, because he was originally in the loss mitigation for regular lending, like just till and respite type lending. He saw an opportunity in hard money, so he started to go over to the hard money space. And I got on board with them in early 2017. 2017. And I was with them for a very long time. And his development team was very slow. They weren't quick to get things done. And after about a year and a half, I just said, hey guys, I can't deal with this anymore. I had to go find a different company. I went onboarded with them, paid a good sized chunk of money to onboard, and then literally, Ray, 3 months later, a deal keeper. They sent a notice to everybody back this past February. It's like, oh, by the way, we're going out of business in March. So if any loans you need to find another originator to go to. I'm like, are you? Like, I was almost Christianity on that one.
And all the money you paid to onboard with them was just flushed.
Oh my goodness, completely. It was gone. That's what. And I'm sure that they were taking people onboarding until the very day that they sent that email. That's what pissed me off, is they knew they were going out of business, and yet they still did that. So anyway, I went back to Chris and Lending Wise and said, hey, like 3 months later, I'm coming back because I was like, Chris, I'm leaving. I can't do this anymore. This is what you're not fixing. So I go back to Chris and I said, hey man, I'm so sorry, but there's nothing out there. There's literally nothing in this space that can do what you do, even though you've got some issues. And he said, Ed, I took a lot what you said, and we went out and hired a whole brand new development team. I fired all my old guys. And I tell you what, Ray, in the last 3 months, I have seen more get accomplished in the last 3 months than the entire year and a half I was with them before.
Wow.
So